Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Layton Kling.
Welcome to this edition of the Retail Focus Podcast with Trent and Layton Kling. Coming up on today's show, we're going to talk a struggling retailer. Struggling might be an understatement in Kirklands. We're also going to talk about the impacts from Hurricane Dorian. We'll talk a little bit about retailers we visited in the last week. But first, we lead off with Michaels. A quick reminder, you can like us or check us out on Twitter or Instagram at Retail Podcast. You can also check us out on just about any podcast listening service. Just a reminder, subscribe, leave reviews, what have you, and those will help others find us. Or if you don't want others to find us, I guess just don't leave a review there. But we lead our show with arts and crafts retail with the latest earnings call from Michaels. Michaels stock has had an up and down week, and we say this a lot. We talk about roller coaster years, that type of thing, but this really was an up and down week for Michaels. They sagged to below $5.30 per share on Tuesday before spiking after the call on Wednesday to around $6.80, then seeing a dip below $6 before surging again on Thursday to above $7 per share, and that's when we're recording, is Thursday, September 5th. Thursday's increase in share price was likely due in part to perceived positivity in China trade talks on a macro level, but also they made an announcement about seasonal hiring that we'll discuss in a bit. But first, Layton, the earnings.
The earnings per share for the arts and crafts and framing retailer, we have to include framing as they are very bullish on their framing market share. The earnings per share came in at 16 cents or around 19 cents on an adjusted basis. This was a 5-cent beat on analyst expectations at 14 cents per share. However, same-store sales continued to be uninspiring, although at least not negative. This is the one bright spot as we see it. Same-store sales increased 0.3% over last year's second quarter, which is behind inflationary metrics for their segment. However, on a successive basis, this was a positive movement versus the over 2% drop that they experienced in the first quarter of 2019. Overall revenue trend was down slightly, around $20 million from last year. This is owing to the closure of Pat Catan stores, offset by the opening of 11 net new Michaels stores in the quarter, and, of course, the small same-store sales increase, which I just mentioned. This is a positive sign for the company overall as far as their future direction. While a number of similarly sized stores are closing, you see on a net basis, Michaels is actually opening a lot of stores throughout the U.S. Granted, Michaels' largest competitor in Hobby Lobby is also said to be in the expansion mode with 10 new Hobby Lobby stores and one relocated store opening their doors within the last month alone. And that, yes, they are a primary competitor, Hobby Lobby is. As far as Michaels is concerned, most of their openings in the third quarter will be comprised of Pat Catan's store rebrands, 11 in all. They will open 2 other locations and relocate a total of 5 stores. And you look, Trent, all of the notes on the call seemed as though it wasn't all negative, but businesses in this segment of retail are naturally heavily exposed to China. So a lot of tariff talk. Just think about the number of times you see made in China on the products at Hobby Lobby, Michaels, or Joann's. And so thanks to this, China was a big topic on the call, both in prepared statements that you can read on their website and in the analyst Q&A, which you can read out there with a variety of different transcripting websites. They saw a small increase in gross profit, just 10 basis points. The increase was a result from pricing and sourcing initiatives that were put in place. These initiatives were offset somewhat by Chinese tariff impacts. Of course, this is to say they are already seeing negative impacts from tariffs, and this could potentially get worse with time as their purchased lots prior to tariffs dwindle, and they must acquire new goods or similar goods from their prior selection that the customers have grown accustomed to. To this point, their inventory on a store basis actually increased 2.5%. We've seen this with some retailers as they attempt to stockpile inventory as a result of tariff concerns. You can actually look at this sort of like hedging against future tariff concerns within a company and trying to get as much inventory with those most popular products as you can while the prices are still relatively low. In-store adjustments, Trent, were also a major subject for the call, and If you look in our regular visits to Michael's and Hobby Lobby stores, it's become apparent that there is a slight difference between the two, with Hobby Lobby featuring more ready-to-use elements like wall art or furniture, and Michael's having a more robust craft component selection.
Now, this is by design, as Michael seems to have identified the core maker as their cash cow. At least that's what they call it, so core maker in quotes. Essentially, these people are far more interested in taking component parts and assembling on the whole than just buying a piece of kitsch for their living space. Essentially, what they're looking at, Michael's, is people that are getting certain items with which to craft. So you're looking at paints, you're looking at elements there, rather than the finished crafted item. And I think this is what sets Michael's apart a little bit in the space. As Layton mentioned, Hobby Lobby has a lot more ready-to-use elements. You can buy wall art, hang it up on the wall, whereas Michael's, you're going to see a lot more of those component elements, and this is by intent, and this chasm has grown even wider over the last couple of years. CEO Mark Cosby from Michael's said on the call their focus on the core maker won't lead them to abandon categories, but rather lead them to build out some categories and getting a more robust selection in those categories to appease that core customer while cutting down inventory in others. So not eliminating those other categories per se, just maybe limiting inventory, knowing that these core customers that they've got coming in aren't buying these ready-to-use items. And he brought up seasonal on the call, which we tend to think of as very much ready-made in this segment. Now, when you look at the seasonal section in Hobby Lobby or Michael's or Joann, you see a lot of things that are ready to go. Things like stuffed pumpkins, things like ghosts, all of that. But in this circumstance, Cosby said something interesting. He said that seasonal actually has a lot of carryover, and it's a strong category for their core maker group because there's significant crossover with the desire to decorate with holiday-specific items. So they're not coming in for the everyday decorations, the everyday wall art, but they are doing this around the seasonal time of year because these core makers they've found like to decorate their houses for these seasonal sections. Now, they're also looking into revamping their customer discounting program. Michael's is shifting back to coupons. Honestly, this is something that we've seen a lot of over the past few years, a lot of automated discounting programs popping up. But honestly, certain consumer groups, like Michael's target customer, just really likes coupons. Now, we saw this to an extent with JCPenney, but I think the example that comes to mind for me is L Brands. The minute they curtailed that couponing program through the mail, they saw a decrease in customers. Bed Bath & Beyond has talked about doing the same thing. Just have to be careful if you're a retailer, because not only have customers come to rely on coupons, but there is a certain segment of the consumer population that likes the coupon concept rather than having something automated, rather than having something they run through an app. And yes, some of this is kind of an aversion to technology for some of these consumer groups, but a lot of it is just having something tactile that they can use at Michael's. Furthermore, Michael's has been able to delve into their analytics from their rewards program to isolate some of these core makers and determine what brands specifically they lean towards. And as a result, products from these brands are gaining more space on end caps and more space near the front of the store. I was in 2 different Michael's stores recently. Both were in the midst of large-scale resets. The initiatives to move more popular merchandise to the front of the stores was very evident. A lot of 4-ways, islands in the front of the store were in the middle of a rework. Some of them were completely devoid of product. Some had 1 or 2 sides devoid of product. There were entire aisles in these stores that had no merchandise. It kind of looked like a Kmart circa 12 months ago. And that's something they do need to get fixed immediately. Here we're in the end of August, the beginning of September. Fall and winter is an extremely busy season for Michael's, not only because you've got the holiday shopping season, but the seasonality in fall and winter is so much bigger for Michael's. Not only do you have the major holidays, Christmas and Thanksgiving, but you've got those overarching fall themes. You've got Halloween on the table. So it's going to be important for Michael's to get these resets implemented in a timely fashion and with as little disruption as possible. And when Michael's does resets, what I found, at least from experience from visiting dozens of these stores, is merchandise actually gets placed in overhead boxes with no customer access during the course of the reset. That means customers don't have access to that merchandise. So if you go in looking for maybe a t-shirt application that you print out and apply to a t-shirt, If they're doing a reset on that section, you have no way of purchasing that. You've got to go to a different retailer. So the quicker the reset, the quicker the merchandise goes back on the floor. And there's one Michael's that I revisited over the span of a couple of weeks, and the resets seem to be moving along pretty decently, but not as quickly as probably what management would like in this circumstance. We're used to seeing boxes on the overheads for Michael's for things like seasonal, for overpack, that type of thing. But again, they'll do it during these resets, and it really hampers their ability to mechanize that merchandise that they would have had back out on the floor. And Layton, one final note regarding this earnings call, of course, the hiring. That was the big story that came out Thursday.
Yeah, as far as their hiring is concerned, Michael's made the announcement that they were going to be hiring 15,000. Yeah, as far as their hiring is concerned, Michael's made the announcement that they will be hiring 15,000 employees in the lead up to the holiday season. As with any holiday hiring, you see a lot of this hiring will be done in the distribution centers as well. Michael's noted in the release that 40% of their seasonal in-store positions last year were hired into regular roles after the holidays. And this is actually something we saw in a number of retailers. Target, by the way, bragging about the fact that they've hired a number of people from seasonal hiring sprees. This number fell, by the way, to 30% in distribution centers as far as Michael's is concerned. What is interesting is the benefits they are offering to the temporary hires. 30% store discount in particular, so that's a pretty steep discount, and a perk if you are just there for a short time and your expectation is that you're only going to work 2 or 3 or 4 months. Perhaps that would help for gift ideas out there for your family or loved ones. And some retailers are beginning to hire seasonal help as full-time or permanent positions, allowing for greater employee buy-in. By the way, this 15,000 number is equal to the number of employees they set out to hire in last year's holiday season. So really trying to say that this isn't a bad sign, but this isn't certainly the type of expansion we've seen from other retailers such as Walmart or Target or Kohl's over the past 2 to 3 years. As is always the case when there is a significant weather event, we look to the potential impacts of Hurricane Dorian, which made landfall earlier this week. There are really 2 impacts from the hurricane: the in-the-moment footfall and then the potential surges before and after. And in the case of grocers, oftentimes the net effect is a push as people stock up on necessities beforehand, but may not get all of the grocery trips for some time afterwards. And there are regional grocers that may miss out on sales as some customers evacuate, but the overall impacts of this are actually projected to be minimal. And the longer-term impacts will likely see spending at home improvement centers rise, as we saw in the 2017 hurricane season, while spending at discretionary retailers like fashion centers may actually fall. And this was much echoed by Planalytics survey, which was published by several news outlets this week. And Trent, if you look at the survey numbers, overall consumer spending could decline in affected areas by as much as $1.5 billion. Again, according to this study, most of this decline may actually be in those aforementioned apparel retailers for whom a 25% traffic decline is expected. Outlet centers are also projected to see a significant decline at 32%. The study also mentions restaurant traffic may suffer with a 14% projected decrease, and interestingly enough, restaurant traffic may increase in areas where residents evacuate to. And this makes sense because you can't always be ready to make food at your hotel. A lot of hotels aren't extended stays, and so they don't have the infrastructure in place to cook food. So expect a lot of people in quick service restaurants or full service restaurants. So evacuees pretty much have no choice but to eat out while they're away from home, of course. However, this may not be enough to cushion the overall negative impact from those sheltering in place. The reason for the drastic expectations, Trent, which we should add, are limited to the Southeast and aren't expected to extend the entire country, of course, is because the hurricane made landfall on Labor Day weekend. Additionally, the hurricane landed in a major tourism center, so that further impacted numbers negatively.
And of course, one thing we should mention is our thoughts are certainly with those that are braving out the hurricane, those that are in the hurricane's direct path. Now, as we've talked about in the past, it isn't, from a retail standpoint at least, all negative. Now, there's no positive that really comes from a hurricane. I think it could be argued. You see a lot of damage done, very destructive. But general merchandise retailers and the likes of Home Depot, Lowe's, Ace, and others may see sales go up as a result, although This particular study, the Planalytics study, cites a potential front-loaded spike for Home Depot and Lowe's. We know from past experience from those earnings calls, sales are impacted more after the fact as residents repair homes. And it's not just Home Depot and Lowe's and Ace and True Value and those retailers, but also other retailers that you might not think of immediately. Lumber Liquidators, the Tile Shop, any retailers that are going to be used by contractors in rebuilding efforts. These retailers are going to see kind of waves as far as customers coming in, contractors coming in months after the hurricane, especially as those settlements come out from insurance companies. Now, Paul Walsh, which was a former actually podcast guest of ours, he's with IBM. He's a weather analyst. Great interview. But he was cited by CNBC as saying that essentially the retail business lost by department stores and the like will eventually move to other channels. Now, this could be for a number of reasons, but again, primarily you're looking at discretionary spending going towards potential preparations or repairs. In the case of some people were suggesting vacations were put off, especially during Labor Day weekend if people were going down to Florida. You're seeing that spending happening more in place, so it will affect the southeastern United States, which is where those Planalytics numbers come from. And as I mentioned, that $1.5 billion in spending declines actually do factor in benefits from other areas of retail. So they factor in the home improvement stores, the grocery stores, that type of thing. But it is just for the southeastern United States. So other ends of the United States, other areas of the United States might be seeing potentially a slight benefit from maybe people not traveling during Labor Day weekend, but that much is pretty tough to tell. We would respond as far as these declines are concerned that the study really only covers the amount of spending declines on the consumer front and immediate spending declines. Again, when you look at increased spending by contractors, which are secondary spending, so to speak, this number could conceivably narrow for retailers. One thing is for sure, though, a lot of retailers had to close down, and because of these closures, you're going to see those lost sales. You're going to see a lack of traffic coming into those stores that are remaining open. Walmart, we know, closed 46 stores at one time. Publix had a string of closures as well, although Publix usually attempts to stay open as long as they can to service the public down there. If you talk about a retailer that is used to these type of impacts, Publix is certainly one of those retailers. They've seen a lot with the bulk of their stores being in Florida. They've been through a lot as an organization. The firm, in terms of Planalytics, says that BJ's Wholesale may also be at risk for losses, which is interesting because you kind of perceive that customers might go to BJ's Wholesale to stock up beforehand. But still, again, you've got closures, you've got a lack of traffic coming in. But a great point was made by Planalytics Executive Vice President Evan Gold regarding distribution centers. He makes the point that a lot of distribution centers are located in this area of the United States, located along a lot of port cities. I was in Savannah, Georgia. I mentioned that on the podcast a few weeks ago. Tons of distribution centers there. Distribution centers for the likes of the Home Depot and other companies that are there. It's going to obviously affect ships coming in with materials from overseas. And Gold said, hey, that's not going to impact stores maybe immediately, but you might see a bit of a delay. You might see a bit of an impact in terms of those Christmas items. Distribution centers right now in September are gearing up for the holiday season. A lot of them actually started gearing up in August for the holiday season to try and get that merchandise out. So any friction along the way, whether it's storm-induced or not, is going to cause a potential delay in getting that merchandise to store shelves. It's also going to cause issues in the distribution center. You might see overtime shifts for workers. When you pay workers for overtime shifts, that means greater costs for those retailers. So it really does have a ripple effect here. There's a lot of things going on with it. Obviously, the biggest effect, no doubt about it, is to anyone that's living in that area, anyone who's had home damage or otherwise has been affected by the storm. And certainly, we hope things turn out for the best, at least as far as the rest of this hurricane's path is concerned, as it continues to tread northward in the U.S. We go back to a recurring segment we've had on the Retail Focus podcast, where each Layton and I talk about a retailer or retailers that we visited over the last week or so. Layton, I know you were in Colorado recently, which is, again, the state that I live. We were talking about how devastated we were that the Kmart in Pueblo, Colorado was announced to be closing just this last week. But As far as retail stores, as far as retail outlets, what are some things you saw and experienced while you were here?
This is probably the least sexy thing I will ever say on this podcast, but auto parts stores. I went into several because they are everywhere, near where you live, near the center of Colorado. There are a number of O'Reilly auto parts stores, Advance auto parts stores. They have a massive presence in Colorado. Seems like I saw one every 2-3 miles, but then also Napa Auto Parts and, of course, AutoZone, one of the nation's largest auto parts retailers. I went into a few Advance Auto Parts, reason being they have a completely different format in a number of their stores throughout several different counties. The square footage varies anywhere from 5,000 square feet up to maybe 12,000 square feet. And it's really interesting, Trent, because this is one thing that you don't see in markets that have pretty good weather, that really don't have a lot of snow. Inside the stores, the back room is often bigger, Trent, because they have a commercial business. So they have to service trucks, they have to service auto centers, they have to service repair centers that are really taking in a number of clientele, a number of customers that come in when the weather's bad. So when the weather is poor, it's super cold outside, cars are having problems because of the snow, the ice, they get in accidents. They're actually servicing a lot of the auto body shops and also a lot of the repair centers that are doing mechanical fixes to the cars. And it's really interesting because a lot of the store workers will actually have store routes. Their entire job, or at least maybe 90% of their job, is to actually drive out and deliver individual parts to all of these different stores that may be up to 160 miles away from that store location. So I thought it was very interesting in the dynamic there, because if you go into some of these stores, it's like Pep Boys, for instance, on the West Coast. Some of the stores are more retail centric, some of the stores are more service centric, and that is exactly what I saw and what I personally wasn't accustomed to. Having grown up in the Midwest, in Kansas, you saw these stores, but a lot of it wasn't about driving away from the store and actually delivering parts to the small businesses. When we talk about the contractor business with auto parts retailers, specifically with O'Reilly and Advance and AutoZone, they talk massively more and more about their contractor business. It's akin to Lowe's and Home Depot and how important contractors are, and that service mechanism that all of them are trying to implement, and how important that is for the top line. I saw it personally, in person, when I visited Colorado, and of course I saw you as well, but I would say my highlight was the fact that all of these stores, they weren't just cookie cutter. They were varied, again, in size and in terms of what they deliver to their customer and how they deliver it. They have not taken to a uniform design, and that was most fascinating to me over the past week.
Now, I know one other thing that you did is you visited a number of malls throughout the area. You like to visit malls when you're on the road. It's a bit different for me because they're all in my backyard, so I don't really have beginner's mind when I go into any of them. What were your experiences there?
Yeah, so as far as conventional indoor malls, which we often talk about as being maybe some of our most favorite retail segment, aside from, of course, defunct Kmart stores. But if you look throughout the Colorado Springs area in particular, there are two main indoor malls that are still in existence, both of which have multi-levels. One is 3 levels, one is 2. You look around, Trent, and you have to admit they're suffering a little bit, one more than the other. And you look in the general vicinity, one had a pretty good retail center around it, one did not. One, you could look in the next 5, 10, 15-year time horizon and really foresee some major struggles. One thing I will say that was in common with both is that Dillard's and JCPenney were in these malls. And if you look, Trent, not a lot of traffic. It may have just been, I don't want to be super pessimistic here, maybe the time of day in which I visited these malls, but just not a lot of traffic. And so if you look at the demographic, if you look at the general traffic around the malls in terms of not only foot traffic, but of course driving traffic, just not a lot. And you really have to be sad for the history that's encompassed in these malls, because I looked up when they were built, you know, they were conventional indoor malls that had a huge following behind them in the 70s and 80s. And then just now you see how it's fallen off over the past couple of decades. It is really sad to see. One last thing I will say in regards to these conventional malls, Trent, is that those JCPenney's, it always seems as though JCPenney is the last retailer to leave these malls. It's as though they're the last one to get the memo that traffic is no longer what it once was.
Yeah, so the two malls you speak of, one is the Citadel and one is Chapel Hills. Chapel Hills doing a little bit better in a little bit stronger of a retail center with higher traffic than the Citadel. The Citadel, I think its biggest lessee might be a school in there, but the Dillard's even in that one has turned to a Dillard's clearance outlet. So again, you see such a drastic difference even between those two malls. I would have to agree with you, though, both seem to be on the downswing. Well, we're going to finish with a retailer on the downswing here today. A struggling retailer we don't much discuss in Kirkland's released earnings on Thursday before the bell. We want to begin with kind of a quick review of Kirkland's and their business, since this is the first time in nearly 3 years we've discussed them on the show. They do have Southern roots. Their founder started the company in 1966 in Jackson, Tennessee. Of late, based out of Nashville, they had, up to the last 2 years, a bit of a growth spurt in terms of store count, even in this last quarter where they struggled so much. We'll get to that in a second. They actually added stores to their portfolio, even with the struggles. Their primary focus has adjusted little over the past couple of decades. They're known widely for their home decor selection, home furnishings, and seasonal gift items. Having listed their core retail competencies to you here, we can see that their competitive base has grown. So not only those other full-price stores there, but notable off-price banners, including At Home, TJ Maxx's Home Goods, At Home being a little bit higher price point than Home Goods, and perhaps to a lesser degree, Wayfair.com and their market share climb as well. Obviously, too, you have to factor in a number of other online competitors, as everyone is wont to do, but the reality of it is the off-price space has grown so much, whether it be through TJX, whether it be through Ross, whether it be through Burlington, and as such, it's put increased pressure to deliver both a free selection of items, or a large selection of items there, and keep prices relatively digestible. So you can gather that the company would face both top-line and bottom-line pressures on recent earnings reports, and that's exactly what Layton's going to be touching on here.
You can see, Trent, that as it relates to them being a publicly traded company, before I get into the numbers, their latest IPO was in 2002, so it's been on the public markets and in the public eye, so to speak, financially since 2002. And the public markets have treated the company in a variety of ways. Of course, there was a lot to digest if you're looking through the company history, with a lot of highs, a lot of lows, and the stock price of Kirkland actually looks to reflect that, with all-time highs reaching $29 a share. I'll repeat, $29 a share in 2015, 4 years ago. The company's shares now sit at $1.17. Again, $1.17 as of recording this podcast, Trent. In large part, thanks to their latest earnings report. So the stock was down 22%. We'll get into those details at the very end of the story. But the company reported adjusted second quarter earnings at a loss of $1.05 per share. This compares to a loss last year at 40 cents per share. So you can see that they are accelerating in the not positive direction. This was so bad that it took most analysts by surprise, and this indicated an over 50% difference in expectations. This is a negative 50% difference in expectations, Trent. Not good at all. And the company revenue was and is going to be the top story for Kirkland's going forward. Revenue decreased 10.5% to $119 million. This compares to $133.9 million last year. So you can see that is not good for a company that is, shall we say, mature in their retail segment. The net loss included one-time items, by the way. I should say that their net income or net loss for the company was $17.1 million, meaning they are wildly unprofitable this quarter. Again, for the second quarter of fiscal 2019, they did note a re-acceleration in e-commerce revenue, this being brought on by higher traffic and better conversion on all e-commerce platforms. And if you look, Trent, they have made a number of changes on their e-commerce platform over the last couple of years. It's still nothing to write home about. And if you look on their website, you could pretty much draw a lot of things up that they could improve upon. And honestly, one of the major things I'll talk about here shortly on the call notes from this earnings report is the fact that they really don't talk about their stores on their website, and they don't talk about their website in their store. So in terms of omni-channel presence, it's just not there. CEO Woody Woodward actually used words such as challenging to describe their current customer base as it relates to their product mix. Executives noted that they need to better utilize their brick and mortar store presence to bring in and optimize their online channels. And by bring in, I mean bring customers in to fulfill online orders. Everything that we've been talking about with the retailers such as Walmart or Target. Of course, this is a niche retailer, but one that still needs to focus on these channels to improve upon sales. The word speed was also used in describing how to implement best practices with omni-channel efforts and getting together a broader, more productive product mix. And I thought this was interesting because, of course, with a niche retailer that sells a lot of home goods and home furnishings and dining decor, you have to talk about product mix because it's almost like fashion trend. Everything changes every couple of years, and you have to be on top of those trends. Honestly, I don't think they have been, not to the degree in which they need to be. In the face of competition, competition has grown, to your point when you introduced this story. They are seeing a lot of competition from a number of outlets, both brick and mortar and online. The one solid point I will say is they mentioned new categories within tabletops and rugs. These are new categories, by the way, that they've introduced within the last year, and they hope this kind of momentum actually carries through with new segment launches and bedding in this calendar year. It's interesting because it almost sounds as though they're going the Bed Bath & Beyond route, trying to really aim for their product selection. Dining products is the last thing I'll mention, actually did well too. Dining products being a new wrinkle in their merchandise game.
Now, they are in the midst of what they call a transformation. They're actually sticking with a lot of the same front office personnel for the most part to deal with the opportunities ahead if you're looking from their perspective, or the potential struggles ahead if you're looking from an outsider's perspective. Woody Woodward, again, their CEO, not the former major leaguer, said that they have the right people and right strategy in place. Basically, it's just a matter of execution. That ever elusive execution. As for the general plans, they're looking to target both in-store merchandising and marketing. This will encompass both new and existing products. The emphasis being on how they convey to the public new items or categories, which is the logical thing to do if you trust your purchasing teams. Operationally, they want to optimize point of sale, make sure that people are not waiting too long at checkout lines. They've noted that they're in the midst of store lease negotiations as well, and they're ready to close certain pinpointed stores if the negotiations do not go their way. How often have we heard this, and yet it seems like retail landlords just continue to win here. They've actually hired a third-party company to look at their portfolio and get to the negotiating table with the landlords. We see this happen a lot as well. One thing I'll note about Kirkland's earnings call here before we talk about their real estate portfolio, Layton mentioned their decreasing sales. Comp sales were down 11.2% overall. Just digest that. That includes e-commerce and in-store. Yet their e-commerce sales, according to Woodward on the call, were up 22% year over year. So do the math. How terrible were those in-store sales? Now, honestly, they have kind of a foot to stand on with landlords in that a lot of their stores aren't performing rather well, but also you look at where Kirkland stores are located. There's a Kirkland store near me, several others in Colorado, in nearby states. Almost all of them are in high-level shopping districts with nearly 100% occupancy. I'm not certain that the landlords are going to see Kirkland's as a major loss, especially since in a lot of these shopping districts, they kind of have the same footprint as a store that's in expansion mode, like Five Below. So that's something that's important to mention. Every earnings call we're on, it seems like with a struggling retailer, they say, hey, we're going to revisit these talks with landlords. It always seems like, just based on the REIT earning calls that we're seeing, the landlords are winning those talks. They're not in a position to buckle because retail vacancy rates are so low right now, despite what you see on the news about e-commerce pushes resulting in massive store closures. You're seeing retail vacancy rates in very, very low positions throughout most of the country, but particularly you look at growing areas like Texas, like California, where Kirkland's has larger footprints, doesn't bode well for them to be able to renegotiate. Now, they opened 4 stores for the first 26 weeks in the fiscal quarter, only closing 1 in that same time frame, so they now have 431 total stores in 37 states. And by the way, Layton, if you look at their sales per store over the course of the quarter, based on just the numbers that we got this earnings call, you're looking at a sale amount per day of right around $6,000 overall, and that's accounting for e-commerce sales. That is not good shape for a retailer like Kirkland's, who is drawing in supposedly affluent customers, mostly females according to them, that like to spend money or that are very brand aware. The company now expects fiscal 2019 diluted earnings per share to be in the range of a loss of $1.25 and a loss of $1.50. The new range reflects uncertainty regarding tariff exposure and also the timing of potential benefits from its merchandising cost and supply chain initiatives. Kirkland's ended the quarter with $15 million in cash, noted at the end of their fiscal year. We'll see positive cash reserves as well, essentially reassuring investors that they do not have a liquidity crisis on their hands, at least not yet. The company's stock ticker, Kirk, saw dramatic sell-off activity after the earnings report, which again took place Thursday morning. The stock price dropped 22% by the end of the day. Shares are down 88% for the year, where they started off near the $10 price point in January. Now they're hovering in the $1 to $2 range. One final note I'll make regarding Kirkland's is their management sees really a potential possibility for them in the marketplace as a what they call a value-priced omni-channel home decor retailer. They see a spot between the likes of TJX and At Home, and then the online pure plays like Wayfair, Hayneedle, and Amazon, and they feel like they're more valuably priced than, say, the likes of Crate & Barrel and Pier 1 Imports, although I would maybe argue that the latter is not necessarily the case, as Pier 1's always had a relatively decent price point there. But the reality of it is, like Layton mentioned, that omni-channel goal just hasn't been attained. There's not a lot of play in between the two channels, and to be truly omni-channel, you need that buy online, pick up in store model. They say theirs is fully operational, but they just don't communicate that to the customer. So if the customer doesn't have that communicated to them, how are they going to know to be able to use that? And furthermore, how are you going to drive people into the stores to pick up your products if that's not fully operational? So that's just something to keep in mind there as far as Kirkland's going into the future. Again, they see their broad demographic as female, high-income, category enthusiasts. They also mention in their latest investor presentation, the home decor market estimated to grow $40 billion or 3.5% per year. The reality of it is, though, we see these sales from Kirkland's plummeting. It's very obvious that Kirkland's isn't taking any of the benefit from that 3.5% growth per year, and instead it's going to those companies that are having a lot of success in the sector.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
We've reached the final segment of the Retail Focus podcast, a segment we call Looking Ahead, where each Layton and I take a look at a retail story we're keeping an eye on for the next week, month, or year. And we begin with Layton.
My story has to do with, again, another earnings-related story. This with Kimberly Clark. We've covered, I believe, only once or twice on this podcast over the last over 4 years. Their CEO has come out, and this was after their earnings came out formally on their investor relations website. Their CEO ended up saying that the U.S. trade war is not really hurting their prices. And this is interesting, Trent, because if you look at the raw goods that go into a lot of what they make, some of it does touch China, some of it does not. So this is important, and this is my looking ahead story, because these are consumer-facing products. We're talking about paper goods in a variety of areas in retail, and of course, diapers and other children's materials that you would use in raising a child and making it grow from the age of 0, let's say, to age 5. And I think that because these are consumer-facing products, this is of note, because this is what a lot of people are talking about. This is what a lot of financial analysts are talking about when they're talking about the trade war. How is it going to affect middle class, lower middle class, middle of the road, blue collar families? And I think right now you're seeing that a lot of companies are being able to maybe either take short-term margin hits, able to maybe source products in a different manner, or just make sure that their supply chain, their current supply chain, and their supply base, so the suppliers that supply Kimberly Clark, for instance, are really hampering down on costs and making sure everything is running as smoothly as possible. And so when you see a statement such as the one made by their CEO that said, generally, we haven't been affected by tariffs because we mostly produce in a lot of local markets, you're really looking at companies that are trying to avoid doing business with Chinese companies or doing business elsewhere, or potentially, like I said, looking at their supply chain and trying to find ways to make things more efficient. This is just one example. I'm not taking sides, Trent. I'm not saying that the trade war is good or bad. We've certainly seen it hit a lot of companies we talk about here on the podcast in a negative fashion. Lumber Liquidators being one, of course. Home Depot actually maybe revising guidance a little bit because of tariffs as well. So I thought this was interesting because Kimberly Clark, again, is a massive company, a huge lineup of products inside the United States that are, again, I can't say it enough, are extremely customer facing. We're talking about Huggies, Kleenex, Continental Tissue, all of those products really meaning a lot for the consumers here at home.
My looking ahead story, I'll go back to the produce section of the grocery store, as I often do. There's a great article in Produce Retailer this last week about a particular session at the Crossett County Produce and Floral Conference where they were talking about reducing organic shrink. And by they, I mean produce retail executives. So you had representatives there from 99-cent stores in California, which has a significant produce section. You have Sprouts Farmers Market there, Raley's as well, which is a West Coast grocery chain. But these produce executives came together and they said, really, the problem for shrink when it comes to organic produce is not produce spoiling. It's not it sitting out for longer than the rest of the produce. It is what's called paper shrink instead. This is a phenomenon where organic produce, you might have let's say a Honeycrisp apple that's organic, gets rung up as a non-organic product, meaning at a lower price point. When they've done secret shopper studies, at least according to Greg Corrigan, who was with Raley's for a long period of time before moving to the supply side of produce, he said that their secret shopper studies found that it was nearly all paper shrink when it came to organics. The problem is, in terms of combating this, you've got the PLU stickers with the barcodes on the product now. However, organic customers, it said, do not like extra packaging. So they don't like the extra plastic, they don't like extra paper, they don't like any of that. They just want to pick up the produce and go. So the stickers are fine, but what happens when the stickers fall off? What happens if it's a local crop and those stickers can't get applied? So it's about knowledge of those particular categories for the employees, and it was talked about how to educate the employees, and that's really what I'm looking ahead to, because honestly, when it all comes down to it in retail, part of execution is making sure you have a well-educated, well-trained employee base. So some of the suggestions that were made were including secret shoppers in that system. Also, giving feedback to cashiers and tracking this type of thing. If you give feedback to cashiers and say, hey, you just rang up an organic product as a regular product that costs the store money, the thought is that they're going to be more mindful of that in the future, doing some scan accuracy tests. But really what it comes down to, honestly, is a multi-channel solution, because if they're going to combat paper shrink and organics, it's got to be on the part of the packers, it's got to be on the part of the merchandisers or the people that are putting out the produce in the stores, and it's going to be on the part of the front end. Now, stores such as Sprouts have a larger organic selection, maybe Whole Foods, whose entire selection is organic, you might not have to worry. But again, if you're in a grocery store that's going to combine and sell side-by-side organic and regular products, it comes down to employee education. So how the organics industry is going to deal with this paper shrink is my looking ahead story. It's probably not something that's going to be solved in the next week, month, or even year, but it's more of a 5 or 10 year thing. What are they going to come up with to try and combat that? Even the playing field for organics in these shopping centers. That'll do it for us here on the Retail Focus Podcast. For Layton, I'm Trent, and so long until next time.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.